welcome to another episode of Real Estate 360 with my good friend, real estate expert, Kenn Renner. How have you been, man?
Sandy, it's been a while. How you doing?
Did you say they've been doing this for 5 years now?
Yeah, we've been doing 360 for over 5 years, but we really ramped it up. Well, remember, it's 5 years ago was when the pandemic hit.
That's right. You know, I do have to tell you this, that my real estate knowledge has become greater in the 5 years that you and I have been sitting down and talking. I've learned about 1031 tax-deferred exchanges. Yeah. I've learned a lot about the rich dad, poor dad philosophy that you follow, and how investing in homes is a good idea.
It absolutely is.
So I've learned quite a bit. Thank you.
I appreciate
I'm not paying you a nickel for that education. but
that's all right.
But thank you.
Yeah, but the podcast, you've been really a blessing to us because, you know, the whole thing is that you are open-minded on the whole thing. And, you know, you're open-minded and you're also in the mortgage industry. So there was like, you know, we've seen these market changes and all these things and navigated through some of the worst and the best of times. And you know, it's been great to be on, you know, getting a perspective from somebody who's a radio personality.
Right. That happens to have their mortgage license.
Happens to have their mortgage license.
Right.
So you kind of get it. So that's been really cool. So yeah, so it's been 5 years, and I remember just before the pandemic is when I was out in Bay Area doing some presentations, and I had like this premonition. I told them that it was in February of 2020, and I said to the group, I said, look, I just know there's a feeling there's something that's going to happen. I don't know what it is. It's going to cause an exodus of people out of this area. And I didn't know what it was. You know, they talked about the big one for the last 50 years. You know, God forbid that happens. But then there was, you know, all these other possibilities. And I even mentioned, there could be the next bird flu or whatever. And people, you know, that were there were like going, well, I hope it doesn't happen. But then the next month, it was like, here it is. Mm-hmm. And so, you know, then we thought, oh gosh, the real estate market's going to crash. I mean, right? You know, no one's going to buy anything. Everybody's going to stop doing everything.
That's what I thought.
It was like instant recession. I was just looking at the charts. You know, it was like the stock market went down like just boom to 2007 levels. And I'm like going, oh boy, this is going to be a rough ride. And of course, the opposite happened. You know, we became the poster child of real estate and real estate investing. And, you know, it just got crazy. And I tell people in my presentations in investing, I say, if there's any market you're talking about and people go, this market is crazy, then it's time to probably think about moving your asset. And that's what I do. Help people move their assets, whether it's real estate assets or stock assets or highly leveraged property or highly appreciated property that needs to be put to work, the equity being put to work rather than just sitting in it. Right. So we're going to talk a lot about that. We're going to also talk about some of the new things that are coming here that are relatively scary with this brave new market that we have, right? You know, things have changed dramatically since the new administration's been put into office and stock market's taken this wild ride. Yeah. And then you have Trump, love him or hate him. He's pulling the triggers on trade wars and potential trade wars, tariffs. He's just that's going to be disrupting prices. Mm-hmm. How is that going to affect housing and things like that? Those are the uncertainty is not good for investors, whether it be the stock market or real estate market. But what's really good about those longtime savvy investors is they realize that this is where opportunities are. So, you got the bad news. The media starts hitting it, mass layoffs from the government. Of course, we've had mass tech layoffs for a long time. S&P, from the beginning of the year, S&P is down 8%. That doesn't really happen in real estate where in 3 months it drops 8%. Right. Nice, 8%, 10% for the NASDAQ. And what's really, I was looking at the charts today and, the stock market's done great. It's gone up 100% since 2019, but it's also super volatile, especially now. And so I saw that just a month ago that we've seen a 10% decrease in the stock market in just 1 month. Right. And I was like, that's a big drop. And then of course it bounces back up. But then the tech stocks got really nailed, Nvidia and all that. They had their great run. But what goes up can come down. Look at Elon's, Tesla down about 45% from its peak. Mm-hmm. That's when I wanted to buy. When I saw it at 222, I was like, honey, do you think we should buy the Tesla peak stock? Right. And then now it's like, it's back to 260 and it could go. But
you want to buy it the low?
I want to buy the dip, right? Right. And that's kind of
everybody wants to buy the dip.
Yeah. So I missed the dip now, and I thought I lost money because I didn't. I tell people, if I'm saying I'm going to invest in the stock market, it's time for you to get out because I've done it before.
Yeah.
I remember I told you the story, when I first moved here in 93, Dell Computers was just getting started, right?
Yeah.
So I went down, I got a $2,200 laptop and it had I think 256 megahertz.
Yeah.
Yeah. I was slower than slow. I could barely type on it.
But it was a computer.
It was good. So I was in the Dell factory outlet and I'm going, do I buy the computer or do I buy the stock?
You bought the computer.
Yeah, I bought the computer. So, but anyways, I love my tech folks because they've done really well and they've got a lot of equity and they deserve it. Interest rates are still near record highs, and of course with tariffs and potential of all these costs going up, we could see inflation. It's going to be a very tentative market. We have to follow this stuff because we're expecting rates to go down. Now if their cost of everything goes up, that's going to force inflation up. But then we're already seeing some of the downticks in the interest rate. I don't know. Those guys out there, I hope are smarter than us. But the bottom line is everything's in flux. Affordability is still an ongoing problem. Inventory is still a problem in the housing market. Of course, then you have your immigration concerns, right?
Yeah.
Got a lot of my cultural buyers that are on work visas and things like that. So it's just a very tentative time. So that's why you got to be on the pulse and talking to people of the know, and also offering solutions in these tougher times. There's opportunities. There's silver lining on everything right now. We're taking advantage of them. It's really, really, really good. Just overall, the nationwide we're up about 2.67% from last year over year. So that's still not bad. And the average price per nationwide is median price is $357. So the builders are also taking advantage with their being able to fund these rates and getting them down. That's what we're taking advantage of is the cheap money. But I want to talk a little bit about the people. What we're doing to help our clients. Get through the uncertainty and get it. If they take this is a long-term investment. This is a buy and hold strategy. But when your buy and hold strategy is you've held a property long enough, maybe it's time to take some of that equity and do an exchange and purchase more property, exchange it for more. You're not selling, you're exchanging it. So we have a lot of people that bought in our submarkets, like in Temple. We had 100% or $100,000 increase in values. They paid $150 for it. It's now $250. Well, they only put less than $50,000 down to buy the property, but now if they've got this $100,000 in equity, that's a 200% increase. That's better than the stock market returns, right? So, but what do you do if you sell? You got to pay long-term capital gains, and if you're from California or high tax states, you got to pay state tax. Then you got to pay depreciation recapture, and then all this other stuff. So we say don't sell, exchange. Because you have people that are selling one, doing an exchange, and buying three more. Mm-hmm. And now they're buying brand new properties under brand new warranties, because those properties, once they get past 12, 13 years, you're talking water heater. Once they get past 17, 20 years, you'll be talking about roofs and air conditioning systems. So it's important. It's great to be able to move your equity into something that's gonna and do it all again. So it's kind of like you guys, you bought one, you did well, you held it on. You do now buy three more, right? With the same equity that you started with, the same house, just depreciated equity. Then take that 3 and 5 or 7 years and buy 9 more, right? So that's how you get to your 10 pretty quick within less than 5, 7, 10 years. You've got 10 properties. So this is what we say, a good rule of thumb: 10 properties in 10 years, pay them off in 20, and you're pretty well financially set. So, so that's kind of what we're really helping people that are on the fence. Should I buy? Yes, you should buy the dip, right? Mm-hmm. When everybody's running, that's when you buy. And so right now they're not running; they're just running to better price market, right? Austin's dropped. We're going to go over the stats here in a second. So should I sell or cash out? And we have some people where they've had a medical emergency or they lost their job or whatever, they have to sell and they need to cash out, and they're taking their money and they're glad they did it. Mm-hmm. And so they have to pay their taxes and all that, but it's better than the alternative of not having it. And that's the other thing. People are concerned, especially in Austin, is the price is going to continue to drop and I lose more and more of my equity. Or should I take it now, take it off the board while it's there? Should I exchange? That's a great way to do it. I mean, that's tax-deferred exchange. We did a whole podcast on that thing. Mm-hmm. I was talking to my IT guy that does our video SEO, and he was saying, you should put that podcast out again because it was funny what he had to go through in a 1031 exchange to make it actually happen for a guy who bought 10 houses from me that exchanged out of a house in California with 1 house to 10 houses. And so, or should I just hold on, and I got this low interest rate on it, I should just let itself pay off. Let the tenants continue to pay it off and it'll be free and clear. Or should you rent and invest? That's been a new trend that we're seeing, especially the young tech people in the Bay Area, for instance. They got their nice job, but they can't afford a home in Saratoga, but they can certainly rent and take the difference and invest in areas where we're buying homes for under $200,000 for a brand new construction home. You could stack up 4 or 5 of those before you could even get your home, even qualify for a home in the Bay Area.
Right.
So we're seeing a lot of people, and if you listen to Grant Cardone, he says you rent where you've got your space, and then where you're living, and then because it gives you flexibility and all this kind of stuff, but invest the rest, invest the difference. Now, it's funny that Grant says that and he pushes that all the time because he's trying to push people into the multifamily, which is great, syndications and all that. But he did really well on several properties that he owned in Miami, and he's made millions on those, higher end condos. So, but the rich get richer, right? All right, so let's talk about some stats here because this is how things have changed. So. So, of course, we're a month behind on our stats because that's when the Austin Board of Realtors collates them all. And so our median price in the Austin Metro, Austin Round Rock, is $430,000. And that's down from 3.9% from last year. Okay. That's not terrible. I mean, we were up 6% in December. I think that was just skewed because maybe higher prices. And then now we're down 3.9% just a few months later. That's still a pretty stable market. My concern, though, is what we're seeing here is the amount of closed sales and the amount of new inventory hitting the market in our area. In our submarkets, it's a completely different market, and it's much more buyer seller friendly. In this market, you're definitely in a buyer's market. So if you're going to sell, you have to be very flexible and very. I'll just give you the stats. Our closed sales for Austin Metro is down 6.5%. We now have 5.7 months of inventory.
Really?
Yes, 5.7 months. That means if we stop, if no more houses hit the market, we still have almost 6 months of houses that need to be churned, and that's up in 1.3 months. That's the highest it's been in over 10 years.
I was going to ask how long it's been.
Well over 10 years. I think 2013 was the last time we had that. So that's a tip. We got to watch these stats because they're going to point to the future. So. Active listings, this is a scary one, up 16.7% to 10,235 listings in our area. That's up 16% from last year at this time.
Wow.
And the closed sales are down 6.5%. Well, that's a problem. Pending sales are down 5%. And new listings are up 6.5%.
So who is this good for?
Buyers.
Okay, that's what yeah.
Buyers and investors.
Right. Do we have a buyer's market?
We do have a buyer's market. Technically, it's usually a buyer's after they said 6.5 months, but I think that's old school. Right? I think that we're definitely in a buyer's market because we're feeling it on a day-to-day. We're out there in the trenches, and we're helping these sellers become realistic with their prices and things like that. Because if you look, 2 things you have to do is first is it's a long time on the market, more than we're used to. 82 days on the market, almost 3 months is the average days on the market.
Wow.
That means half of them are selling longer than three months. So when you're selling a home, you have to be patient and realize and price is pretty much price and the quality of the house is everything. But this is an interesting step. The average close to list price from what they listed it at and what they actually took the property, these sellers here in Austin, is 93.5%. That's so on a $500,000 home, that means they're taking on average $467 or almost $30,000 less, $467,500. So that's something we have to educate our sellers. Going, people go, well, I just raised it another $20,000. Go, no, show it because they're not dumb, right? I mean, they got the same information, and plus you got these builders that are just basically giving these houses away with 4.5% interest rates. So you really have to be creative, and you also have to get with a professional and know some of the other techniques. Like there's all the FHA loans are assumable, And there was a lot of people bought their homes FHA. Those are assumable. You might have a 2.5%, 2.75% assumable loan. Now you're in you can compete. I'll give you an example. We have a house up in Santa Rita Ranch. Took the listing 625. Not much sales activity at all. Not many people going through the door. I said, well, why don't we lease it out? That way, at least you have a $3,100 payment. At least we can get $3,000 or about there for rent. And then that way you're not bleeding out this money, and you can hold on to it. And you've got a couple of years. You got 3 years to decide if you want to keep it or sell it. And if it goes up, you won't pay capital gains on it. But at least you don't have to fight with an empty house month after month and things like that. Neat thing about it is they have a 3.5% loan that they're willing to do a subject to on. In other words, it's like an assumption, but it's not. But it's people could take over that loan if they put down the down payment. Now you're competing with the builders. So being able to I can take that original loan and keep it in place and do what's called a subject to or a wrap. Said, yep, you can do that. So we did get a tenant in less than 30 days, which was great. People were starting to fight over it because it was the right price, nice house. Got them in there. But guess what? We could still sell that house to an investor, and we can still do a subject to loan. So in other words, just because there's a tenant in place,
changing the landlord.
Yeah, it's just to change the landlord.
Yeah,
and we do that a lot. In fact, one thing we do is we buy houses from the people that need to sell them, but they don't want to move. We just lease it back to them. We've had that happen a lot of times. So it is 2019. Our values have basically doubled to 2022. It was 2022, June of 2022, and they went up 100% from 2019 to 22. Then they dropped 20%. So people go, oh, the market's dropped 20%. No, it went up. If you bought in 22, that's another problem. If you put 20% down on a house in June of 2022, you might lost. So what do? Do you cut and run, or do you lease it out? And that's what we're seeing a lot of leasing on. Low rates, subject to submarkets. Our submarkets doubled, but this came down 5%. So, the Temple properties that we have, they still have their equity, and they've done really, really well. So we are seeing the first timers come back out into the market, but it's still very tentative. This is a cool slide here, is because the board, the Austin Board of Realtors, started putting out stats for lease. And this is good because we have a lot of investors that are like, oh, what happened to our rents? Well, they're down. They're down about 18% from the peak of June of 2022. But they're still decent rent. At median rent right now is about $2,195 a month. That's down 2.3 months of inventory. Not a whole. That's not bad. So when they can't sell, eventually people decide to lease it. That's where they do. So we're seeing active leases. It's a balanced market. 3,800 active leases. New leases 2,000. Pending leases 1,900. So we're seeing things moving, and you can expect a 2 months on the market marketing time. We don't like it going beyond a month. We get them leased. We get them marketed. We get them leased. You got to be flexible on your leases. You got to be flexible taking pets and all kinds of stuff in this market, and know the rules. And so what we've been doing is taking a lot of people from these appreciated markets, including Austin. They've owned the properties for 5-7 years, and then we're having them do the 1031 to 3 properties or 4 properties. And so looking at the stats for San Antonio market, we do a lot of work in San Antonio, New Braunfels, because the prices are almost half of what Austin prices are, and the rents are almost 90% or 80 to 90% of what you can get in Austin. So the numbers work a lot better. Plus, our builder's offering 5.25% 30-year fixed financing. Hard to beat that for a mortgage guy.
It's really tough to beat that.
Plus, they're paying 2 points on top of that.
Right.
It's like, gosh, they just it's really hard to compete with, right? And we just closed on one under, it was $189,000, 3-bedroom, 2-bath, 2-car garage in a master plan community, 15 minutes from New Braunfels, beautiful town, right off I-35. But you look at our stats for a much more stable market in San Antonio, is that single families prices, a change from a year ago is down 2%. That's single family new and existing. The residential real estate sales, the values changed is 0%, pretty much equal. Then existing home sales are the sales price is up 2%, and the residential rental rates are still haven't gone up or down. So as far as value is concerned, so we are talking about the opportunities where people can get out of their homes that they've owned for a while, or they want to not be tied down to a house, because a lot of these tech workers move around a lot because they get the contract labor. It's like, well, why don't you rent, but you're making all that money, you need a tax shelter, you need benefits, just buy a rental property with that extra money you're saving, and then you're free to move about the country. So we'd look at helping people with all kinds of different opportunities. Next month we've got the property taxes coming up. We always do a presentation on the property taxes and how to, that's been a big, thorn in, everybody's the high property taxes. Well, they've all come down.
Right.
It's just a matter of our escrow accounts haven't caught up. So,
right.
So
a lot of great strategy here.
I did 500 sales between 2022, all remotely between 2020 and 2025.
Wow.
So I've been busy, but now it's time to help people do it again.
Yep. It never ends, right?
Yep.
You never get to spike the football.
Yep. Buy the dip and do it tax deferred or tax free.
Always good seeing you, Ken. Great information.
Thanks, Sandy.
You bet.
Talk to you next time.